Uh, First and foremost, how is everybody doing? How are we? Are we good? Okay, I can't complain. You haven't got accounting back. When are you having accounting? Oh. Forget about it, man. You'll probably only see it next week. Yeah. I'm sure you'll only probably get your feedback next week. And then they'll probably also need to discuss whatever feedback before they bring it to you guys. Yeah. So anything is possible. You never know. Right. So today I just want us to get into learning unit 3. Okay. And learning unit 3 is dividend policy. If we were not revising on Friday, I think we would have probably finished this learning unit. But it's fine. I think yeah, I think let's do our test on Friday. So let's get into it, right? So the stuff that we're going to learn, or what we need to ensure that we get out of this session. The slides, yes? Slides on. I think all my slides are on arc, right? Yeah. But I definitely changed the learning unit 3 slides. Okay, and I'll show you the slides that were changed versus the old one. So you take note of that. Okay, the key stuff that we're obviously going to be going over is explaining the cash dividend payment procedures in South Africa. Okay, how do we arrive at having paid out? Please just close that door. Having paid out a cash dividend. All right, and then evaluate dividends from accounting, shareholder, and company's point of view. Okay, very interesting. I think most of the times we just talk about dividends from an investor or shareholder standpoint. Okay, and then explain share splits and share repurchases and the firm's motivation for undertaking each of them. Okay, I think you'll get more detail regarding why the firm would actually participate in that from the textbook. Okay, and if you can get additional resources, it would be worthwhile just to further give you understanding. Okay, because I think some share splits, for instance, may seem like it's only beneficial to the company. Okay, so it would be good to understand why would you hang on to your shares in such an event, okay, as a shareholder, so on. So yeah, get as much information as you can there. Then calculate the dividends payable and the impact thereof under various dividend policies, okay? So I think we'll only start to look at some calculations tomorrow. I am seeing you tomorrow, ne? Yeah, this is that week. I think this is the last week though that I see you this many times, huh? If I'm not mistaken. And then finally, calculate the impact of share splits and share buybacks. Okay, right. So before we actually finish this learning unit, we will obviously see the impact of share splits and buybacks. Okay, so here on the overview, we're basically just highlighting the fact that in an ideal world, when the company obviously makes a profit, okay, we then have retained some of that profit, and out of those retained earnings is where we pay out our dividends to shareholders, okay? And dividends, we know, is the reward that shareholders obviously get for the result of investing in the company and taking on risk, okay? In this learning unit, we will examine the cash dividend payment procedure in South Africa, evaluate dividends from the point of view of the accounting, shareholders, and the company. Next, so this is pretty much reiterating what we mentioned earlier. Okay, so I won't read that any further. Okay, so here now they just go on to define what a dividend is, okay? Now remember, I think since first year we've been saying profit is the reward that owners of the company are entitled to, okay? But we don't pay out all of the profit, okay? All right? Sometimes we may, but dividends can either be all of the profit or it can be a portion of the profit, okay? So here, if ever they ask it in a test, all right? And we all know test 2 is coming up. I believe, Nadia, you said the 26th? 26th. Okay, so I must add that to my timetable. The distribution of profits to the holders of equity investments in proportion to their holdings of a particular class of capital. Okay. I didn't see it in your textbook when I was going through it, but I don't think they actually go into the classes of capital. So those of you who may be fans of Warren Buffett, for instance, what company does he run again? What's the name of his company? Berkshire. Yes, Berkshire. And obviously, you know that there's Class A shares, there's Class B shares of your of that company. Okay, so this is pretty much what they're talking to here. And obviously, with one class, you may have voting rights. With another, you may not have voting rights, and so on and so forth. So there's certain benefits, and also the price of those different classes will vary as a result. Dividends are generally paid out of retained earnings. So this we have established. Okay. Now this you also already know. Internally generated funds are often thought to be free for be a free form of finance. Internally generated funds do not have a cost. Do have a cost, an opportunity cost. Okay. Assumed to be the cost of equity. Okay. Right. This is why we need to ensure that shareholders are getting a return on their investment, because they could be in the Bahamas enjoying the money they obviously have plugged into the business, or they could be earning a better return elsewhere. Okay, so we have to make it worth their while. And then obviously this diagram is basically just highlighting how our dividend decisions, we mustn't think of them just in isolation in terms of, okay, how much are we paying out to shareholders? Okay, we must understand that in paying money out of our retained earnings to shareholders, we are then foregoing financing a project or investing in something, all right, that can yield us a return. Now, ultimately, at the end of the day, we must then ask ourselves, whichever or whatever decisions we decide to do with our retained earnings, is it increasing shareholder wealth? Okay. So just wanted to show you that those are interlinked, all right? So here now, they're just highlighting the fact that we have a dividend policy, which obviously refers to the financial policy that we have in the business in terms of how and when do we pay our future or current dividends, okay? The dividend decision depends on the existence and size of the company's distributable retained earnings and the company's future earning potential. Why do we say it depends on the company's future earning potential? Talk to me, financial professionals. How does our dividend decision depend on the future earnings potential?
So you have to, you don't believe that you're going to have income generating investing, or you have this income generating investing going forward. You're kind of inclined to retain more than anything else.
Okay, so you touched on quite a few things there. So if we don't imagine that we are going to make more money, firstly, are we going to pay out dividends? If we are going to make the same amount of money, are we going to pay out dividends? Yes and no. Okay. You could argue it both ways, isn't it? Okay. And if we're going to make less money, are we going to pay out dividends? If we're going to make less money in the future, are we going to pay out dividends?
Yeah.
In the future, we're talking about the future. But again, we potentially could, isn't, depending on how much less we might be making, because we might still very well be able to cover all our expenses and cover any desired investment into the company. Does that make sense? So the only thing that I'm prompting right now is for you guys to start considering the different cases and realities that a business or a financial professional should consider when thinking about should we pay out dividends or not. In other words, the dividend policy of the company. Does that make sense? Okay. Retained earnings are an important source of internal funding for the company because, as we learned in Learning Unit 1, they're cheap. Okay. And then there's obviously no need to start, what do you call this? Meeting certain requirements as you would if we were raising a new share issue, for instance. Okay. So take into account that what we've learned thus far also spills into this learning unit. So as you stumble on some theory questions, you can obviously share some of your knowledge that you have learned in previous units. So then here they just go on to now talk about cash dividend payment procedures. Okay. So they actually are just highlighting the key dates. Okay. And you guys must be able to explain each and every one of these terms. So you got the declaration date. Okay. Somebody tell me, what is the declaration date all about? I think the answer is pretty much in the name. What is the declaration date all about?
Will you declare them at the date declared?
Yes, this is when the directors declare that this year at Pick and Pay, we're going to give all our shareholders a dividend. Okay. But we don't just declare that we are going to pay a dividend. We also declare how much we're going to pay. We declare when we're going to make that payment. Okay. So all the relevant information pertaining to the dividend that we're going to pay out is communicated on the declaration date. Okay. Now, last point there, they say the accounting entries would be to decrease retained earnings and increase the dividend liability. Okay. But that's not when the retained earnings is actually paid out, or that would happen on the day of when the payment is actually, no, if you're increasing the liability, then yeah, they're doing it preemptively. So yeah, that is not the declaration day is not the day that it's paid out, is what I'm trying to get at. Now you have the record date. Okay, so now the record dates here, they're just basically, this is the date on which the company actually looks at all those who are actually shareholders, okay, and all those who are going to receive a dividend, okay, the upcoming dividend, okay. Now, X dividend date. Anybody who buys the share of Microsoft, Apple, whichever company it is, okay, after the X dividend date is not going to receive a dividend, all right, or receive the upcoming dividend, let me say it like that, okay, because they would have purchased this after the closing period. Does that make sense? So naturally, tell me something. Let's say if the Apple share price was $10, okay, let's call it $10. Before this ex-dividend date, right? Now we know that we can only receive two types of returns, isn't it? Either we're receiving a dividend, right? Two types of returns on a share. Either we are receiving a dividend, right? A payout as a result of owning that share, or we're selling the actual share and getting back the share price, isn't it? So those are the two cash flows that you can get from a share. So if you have purchased after this date, it means that you're not receiving a dividend, right? So will the share price of that Apple share post this ex-dividend date be higher or lower or the same? Why do you say higher? Yes, explain.
So prior to the declaration of dividend being paid out, your only return is estimated to capital appreciation by the seven. Whereas when once they clear the dividends, in between the declaration date and the dividend dates, you now know that should I have or should I hold
Yes.
this particular share?
Mm-hmm.
It'll be worth it. Because of the dividends as well. Yeah.
But you're not receiving the dividend, right?
No.
Because you purchased it after the closing date.
Yeah.
Hmm. I agree with your logic that if I'm going to receive a dividend, in other words, a cash flow, as a result of holding this asset, I should get more money, isn't? So if I'm getting more money off of this asset, the present value of that asset, in other words, the stock price of that asset, should be higher. But now we're saying you are not getting that cash flow. Yes, other people will. Those who purchased before this date. So these people will get that dividend. But you, because you purchased after this date, you won't. So is your share price going to be higher than this?
Same share.
It's the same share, but it's not going to be the same share price.
Right. So if you buy the $10 March, you get a dividend in April, and the ex-dividend date is in June. If I buy it in May, the expectations are reduced, the price increase. I'll still benefit from the appreciation of the share price.
Yes.
Even if I'm not receiving.
Yes, you're gonna benefit from the increase in the share price. He bought the share before the X date, right? He's gonna benefit from the cash flow and the appreciation. So can you see, he's gonna have a higher return than you. Does that make sense? So if we present value the value of your share, and we present value the value of his share today,
They're like saying the same share.
they're not the same. Is it making sense? Are we all together on that? Remember, the value of a share price is its present value of all its cash flows. Does that make sense? So if you are not receiving a dividend, the present value of your share is going to be less than the present value of the share of somebody who is receiving a dividend. Are we getting that? Is it making sense?
So if we, sorry. So if you were to put on like formula,
I want to.
your one part of the thing is zero if you're not receiving.
I'm going to make this very, very simple for you guys. Sorry, but go on. Just repeat what you were saying.
I'm just saying, so like if you think of return on investment as capital appreciation plus the cash flows, if you're not receiving the dividends,
Mm-hmm.
you're not getting the cash flow.
Yes.
So inherently, final value that you have, that's minus the cash flow. Whereas the person that's getting the dividends, include the cash flow. So then
Exactly. 100%. So remember, we are saying the present value of any asset, by the way, the present value of any asset is all its future cash flows discounted to today. I'm just going to put PV. Okay. That's the present value of any. So the share price of these Apple shares is all the future cash flows discounted to today. Now we know that cash flows, it comprises of two things. One, the dividend, and we're assuming that this is a dividend paying stock, because there are some stocks that don't pay dividends at all, right? And therefore your only return on that is when you sell it. Can you see that? Because assuming that we've had capital appreciation. Okay, so we're saying that we have two types of investors here. Okay, one is the person who is going to receive a dividend. Div receiving shareholder, isn't? And then two, the person who is, I'm going to call it X div. Okay, so both of these individuals, let's say in a year's time, that share price is going to be 15 Rand. The share price, isn't it? Okay. But now the one also would have received a, let's just call it 2.50 Rand dividend. Can you see in brown, the person who's receiving a dividend, we are discounting 17. So our future value here, and we can even end off here because I know you guys will get it from this point. 17.50 Rand is what we're discounting for the person who is receiving a dividend. Now, for the person who's not receiving a dividend, what are we discounting? Just 15. Can you already see why the share price of the person who is not receiving a dividend is obviously going to be, in other words, the present value is going to be less than the person who is receiving a dividend. Are we making sense now? Is it making sense? Okay. So that's pretty much all that I was trying to highlight. Actually wanted to say something. Have you been answered or you're fine now? Okay. Right. So payment date, pretty straightforward. This is the date on which the shareholders are obviously going to receive their dividends. Okay. And this date is obviously communicated on the day of declaration. Okay. So here now it says the accounting entries would be to decrease cash and decrease the dividend liability. Because can you see now, earlier on, we said we're going to increase the liability. Now we're decreasing it because we've actually paid that liability. Okay. And you're decreasing cash because money is going out of the bank. Okay. So this was just the diagram that I added on because I said, look, now you can actually visually see the important dates we're talking about our dividend policy. So we have the declaration, and here they're using an example of Pick and Pay. The share price is 5,290. Okay. Now, the last date to trade com dividend, in other words, the dividend that is going to pay us, sorry, the share that is going to pay us a dividend. Okay. So that was 6th of June, 2014. Now look what happens. The X dividend. So otherwise, in other words, after the 9th of June, we won't be able to enjoy the dividend that has been declared, the upcoming dividend, if we purchase this share. Look at what happens to the share price. It has decreased. Can you see that? And this is now just showing what we've just been explaining. Okay? And then record date. Now, don't confuse this. Remember what did we say the record date is all about? It's the date where we as the company, right? Or maybe as financial managers, we just go and look and see, okay, who are our ex-dividend shareholders and who are our com dividend shareholders? In other words, who's getting paid a dividend, who's not getting paid a dividend. That's all. That's why we call it record date, because we're just looking at our records and saying who's getting, who's not, okay? And then obviously shortly after, you can see it's just a few days before the date we actually made payment. All right. So that in a nutshell is what we are talking about relating to our dividend policy. So here now they are talking to theories, okay? And when they're talking to theories, they're basically saying approaches that we would then utilize in paying dividends. So residual theory of dividends. What do we think this is all about? What are we talking about here? We're talking about residual theory of dividend. Can I give you a hint? Residual. Yes, it literally is with regards to the amount left. Okay. So, in other words, we're saying, if you actually read the second half of the first point there, we've made all our investments or taken care of whatever financial needs we may have, or things that we want to cater to. And then we say, okay, whatever is left thereafter, we're going to distribute to shareholders as dividends. Okay. So yeah, usually I can't see anything outside of investments, because if we're talking about retained earnings, it means that we've made a profit, right? And for us to have made a profit, it means we have covered all our expenses, isn't it? So pretty much it's probably just investments and other such projects. So once we've exhausted those, then we obviously will pay out whatever is left. And that really is your residual theory. Theory when it comes to, I actually would call them approach. But hey, who am I? Okay, so here now, the second one, they're talking about dividend irrelevance theory. Okay, I must confess, when I came across these guys, these economists, I didn't realize how important they were to finance, because they're also quite influential in economics. But their whole theory, and I'd love for us to discuss this, is that dividends are irrelevant. Irrelevant in terms of the price of a company. They don't have an influence on the price of a company. Okay. Their argument was that dividend policy is irrelevant because a company's value is determined solely by the risk and return potential of its assets. Okay. If dividends did impact the value of a company, this would be attributed to the information content of dividends. What do you guys think? Do you think dividends have an influence on the value, in other words, the share price of a company? So in other words, whether we are paying dividends, whether we're not paying dividends, no impact on our share price. Because remember, we said we use share price as a proxy. In other words, we use that as an indicator of some sorts of the value of your company, isn't it? So do we think dividends are irrelevant, as these economists propose? I can't hear you, sir. They're relevant. Why do you say they're relevant?
If person buys your dividends and you tell him what doesn't happen, buys your shares, and you're telling them that you won't get any dividends, obviously then ultimately the cost for you as the business owner to get the person to buy your shares will be high.
In other words, the return that you must offer them must be high to make it attractive for them to. Okay.
Opposed to if you pay dividends, then the cost would be low.
Yes.
So I think dividends is actually relevant because of cost as well as.
Anybody else? Yes.
I think it's not one size fits all.
Uh-huh.
I just try to find companies that don't pay the dividend, apparently Berkshire doesn't.
Yeah.
So it's kind of for you to afford to be arrogant enough to not pay the dividend, you're kind of communicating that it's the capital appreciation and cover the shortfall.
Yes, yes.
That makes sense. It's Amazon, I think, so that's the dividend.
Who?
Amazon.
Okay.
So you can't be a regular publicly listed company. If that makes sense. So I don't know.
You can be, but obviously you guys are now, you're basically sharing what he's also saying, that the return has to be so attractive that investors are comfortable with foregoing a dividend.
Because then like you're not receiving cash flow. So
The only time you will make a return is when you sell the share.
Yeah, and if anything, as much as it appreciates, you're gonna have to pay capital gains. So you have to still account for the fact that that's gonna reduce
Your returns, your profits. Yes.
So it's kind of a big of, the stock has to be attractive for you to not be able to pay out of it.
Okay. No, I hear you. And one of the things that you guys learned last semester is $1 today is worth more than $1 tomorrow, which is why we then say we must apply interest or a cost of capital to this so that we can be compensated for that opportunity cost of investing in the relevant company. Okay. So you can really argue this thing both ways. Okay. And part of the reason why here they highlighted the dividend, if dividends did impact the value of a company, this would be attributed to the information content of dividends. In other words, on the declaration day, if we say we're not issuing a dividend, you must understand if we say we're not issuing a dividend, right, and we have in the past been actually issuing dividends, the market is going to interpret that as we don't have money, or these guys, their profits are not. Remember earlier we were discussing, if you have profits, are you going to pay a dividend? If you don't have profits, are you going to not pay a dividend? There are some companies that will actually, I've heard of this. I understand in South Africa it's illegal, but I heard of it in South Africa. So I'm not too sure. I think it's about the extent to which, but there are some companies that will borrow money to try and ensure that they at least pay a dividend, okay? Because of such things. So it does have an impact on your share price, okay? So again, you can argue it both ways, but you can also say that impact on the share price is the market reacting to the information, and obviously it may revert back to its mean or to the correct share price over time. Does it make sense? So it's just noise, in other words. Okay. Right, but let's proceed. Okay, so here I think they're just unpacking that more and more. And one of the things that I think I will highlight, you guys should go and read on this to get more context, but clientele effect. Okay, and here they're just speaking to the fact that the clientele effect suggests that a company will attract investors, all right? So in other words, the clientele whose preferences in respect of dividend stability and capital appreciation match those of the company. So you highlighted earlier that Amazon and Berkshire don't actually pay a dividend. I can imagine that because at the end of the day, the confidence we have that those companies are going to be around 10 years from now also allows us to say, it's fine if you don't pay me a dividend. But if I start Aubrey CC tomorrow and I tell you I don't pay a dividend, it's highly likely a lot of people will be skeptical, because if my company tanks, everything you've invested, gone. Can you see that? But what's the likelihood that Amazon or Berkshire is just going to disappear into thin air tomorrow? Okay, so that's what they are also speaking about over there. Okay, right.
So you still receive a dividend if you own company that's part of the index fund.
You would get the dividend. So in an index fund, who wants to explain an index fund before I get into it? Index fund. Yes, guys. How, guys? Yes. What is an index fund? 100%. It's a basket of shares. Okay. So some of those shares are going to pay dividends. Some might not. So now, your question again was,
So it's,
are you going to receive it?
yeah, so for the ones that pay a dividend, still receive.
Yes.
Part of it.
You can. So you usually when you get with a financial planner or your broker, whoever is investing on your behalf in that index fund, you will either choose to get your dividends paid out to you, or you can ask them to reinvest those dividends, which will further increase your returns over time. Yeah, but you will. Okay. Right. So here now they're just talking about the assumptions of dividends irrelevance theory, okay? There are no taxes. There are no transaction costs or flotation costs. The dividend policy does not influence the capital budgeting decisions of a company, okay? Information is available to everyone, including investors and managers, okay? Then finally, the cost of capital of a company is uninfluenced by the leverage taken on, okay? Some assumptions we've seen before, ne? Okay. And then we have dividends relevance theory, okay? And here they're saying this theory suggests the opposite, that there is a direct relationship between a company's dividend policy and its shareholder value, okay? In other words, its share price, okay? And here, I love this, they say a bird in the hand argument, okay? So in other words, that investors consider a current dividend pay to be more valuable than uncertain future growth. Okay. And going back to what we mentioned earlier, this is why we say $1 today is worth more than $1 tomorrow. Okay. Because we know inflation can happen, COVID can happen, markets can crash. The list is endless. Okay. Right. Okay, and then here they're also sharing their assumptions in connection with that. Okay. So here they then go on to speak on factors affecting dividend policy. So profitability, I think we've labored this point, you know, whether we are making actual profits or not, whether those profits are also sustainable. If they're not sustainable, then obviously we'll be more conservative with our dividend policy. Then growth outlook, okay? If we're saying, look, there's going to be quite substantial growth, okay? Then we'll say, look, guys, this was also something not only Amazon, but Uber. Their approach was we're going to have significant growth. And so, again, the communication would be, guys, the investment or the return that you will then realize would be so substantial that it's worthwhile for you to forego actually getting a dividend. Okay. So if you are an investor who's looking for growth stocks, and here typically you'd be looking at technology related like stocks, because we know our technology apps, it's pretty much unlimited scale. Then obviously you are probably someone who's more likely to not be too keen or interested in a dividend. Okay. So here now they're just informing us about legal constraints. So here, dividends declared and paid by any company are subject to the laws and rules of the Companies Act 71, 2008. A company must satisfy the solvency and liquidity test, okay, in section 4.1 of the Act before any distribution is made to shareholders. Okay, they don't detail this in your books. So I think it's just something they're making you aware of. And then contractual constraints. Many companies may be subject to covenants imposed by legal contracts, which place restrictions on their ability to distribute dividends to shareholders. Okay, so if you've taken out quite a lot of debt, FNB might very well say, no. You can't be paying out dividends until you've at least paid off this amount of the loan, etc. Okay, then liquidity. Okay, this is another one that I think we pretty much passively discussed. The company needs to ensure that it has sufficient cash resources to pay a proposed dividend. Paying dividend should not affect the company's day-to-day operational cash requirements. Okay, so I think before we go on, let's take our 10-minute break. And then when we get back at 5 past, we'll then just finish off the slides. And we'll then jump into exercises tomorrow. tomorrow. Any questions, thoughts, concerns before we go on break? Everybody happy? Okay. Super.